The employment picture has been fairly bleak over the last 2 years. So there's almost, if you look between the line, no growth in employment Australia-wide or in New South Wales in the last 2 years. And that's a key driver of office demand. We'll show you some pictures and talk about some issues in relation to the Sydney market in our panel discussion, which look very similar. The point on the outlook for employment is that the leading indicators, the job advertisement series, the leading index of activity, are still pointing to a continuation of that trend in the next 12 months at least. So there's not a lot driving new demand for office space next year. This slide summarises our views in terms of the direction of rental growth across key sectors at a high level next year. So for office, consistent with that employment story, this year we're running at about a 5% pace, and that's really reflecting low supply, reasonable demand, but essentially low supply. Going forward, we think that fundamental of flat to weak employment activity will push down rents back towards their 10-year average. So we're expecting 3.5% growth in office next year. In industrial, as I mentioned, that was the momentum story. So connected to activity we're seeing in wholesale, transport and distribution. We've seen good growth in rents this year relative to their 10-year average. So we've got rental growth currently at 2.5%, and we're expecting growth more around 3% next year. Low supply, but good activity supporting that market. And retail, I said we thought retail and consumer sector, the worst had passed us. While we've seen rents growing at under half their 10-year average in 2012, we expect that is positioned to improve a little next year, but to still remain well below as I said, the averages we've been used to in that segment. If I could put on the investor hat now, this slide really shows me some key insights into the investor's mind over the last 5 years. On the left-hand side, we have the dividend yield in the share market. So that's basically how have investors priced growth assets or risky assets, all the way over to the right-hand side, where we've got how investors have priced income, certain assets, government bonds. Now, property's always floated somewhere between the two, but what you can say is between 2007 and 2011, which is the middle column, that property pricing tended to look a bit more like equity pricing. So it was being repriced for risk pretty extensively, as were equity prices. You can see there the dividend yield and the property yields moved upwards to the same sort of extent. But last year something's changed. So one, obviously government bonds have rallied more, but two, property yields were actually flat whilst risk yields increased. So to the story that property is starting to look more attractive from a certainty, an income generating, a long-term perspective, what we've seen over the last 12 months has actually reinforced that trend. It's possible we got over the initial hiccup of the GFC in those first 4 years, and property's attracting probably more its rightful place as a long-term income generating asset. It's being priced more accordingly to that. There is one thing though that we should bear in mind. If we focus on the spread between property yields and government bond rates, we see that spread's very wide. It's historically high, probably 2-decade highs. You'll see a similar thing between equities and property as well. But there is a reason for that. And the risk premiums that Australia attracts at the moment are well demonstrated through the cost of funds. So if you're actually looking at borrowing from a bank as a large to small business, a medium business I'll call it, because I've looked at an average, you can see that that spread's also elevated relative to the government bond rate. So that risk premium embedded in borrowing rates, embedded in the cost of capital, is actually very relevant for the yields we see in asset pricing. So I think the outlook, I've put an arrow there with a question mark, but the outlook for the risk premiums that we see in debt markets globally is actually critical to the ability of the property market to unwind that premium we see today against bonds. And that's the great uncertainty. But one thing we could say is we wouldn't expect that uncertainty to change dramatically in the next 12 months, given what Nick's described around the global environment and still the uncertainties there. We would be a little different to other Asian markets in that sense, in that Asian markets' banking systems tend to be self-funded from deposits. So because we do rely on bringing in capital to fund ourselves, we are a little more exposed to that. So in terms of the yield story, that's explaining some of that gap between us and other markets. And the final thing I'd say is that, and similar to that, we don't expect capital values to move out too far out of line between equity markets and office or other property sector markets over time, simply because the equity markets are valuing the tenant's business and there can't be a misalignment between the tenant's business and the growth expectations there and the office markets. So over time you see a fairly good relationship between the two. Last year we saw a short-term deviation, I think because we had some good rental growth in office in that case. But we really need to see a broader based turnaround in confidence and expectations for growth to expect strong growth there in capital values. So let me say, the sky's not falling in. It's steady growth, but there's a few issues holding back growth in the broader economy over the next 12 months. So with that in mind, I'd like to call up our panel so that we can delve a little more into the issues affecting the Sydney market.